Hello! On this very first video on portfolio management, we will introduce the basic asset classes. These are equities, and what we have in mind over here are shares of stock of publicly listed companies. An example of a security falling in this asset class is Alibaba Group stock trading on the New York Stock Exchange. Our second asset class is fixed income, basically bonds. One example is 10-year Spanish government bonds. If equity and fixed income securities don't mean much to you, then I would suggest that you take a look at the set of videos I've prepared for you in the two module sections that are specifically devoted to covering them. After that note, let's move on to our third asset class, that of cash equivalents, also known as money market instruments. You can view this as short-term fixed income securities. To be precise, they have original maturities of lower than or equal to 1 year. Because money market instruments share some commonalities with traditional fixed income securities, they are typically viewed as a subsector of the fixed income market. That's why we'll see them in more detail in the fixed income module section, despite the fact that they make up their own asset class. One security falling in this spectrum is treasury bills. These are US government bonds that mature in a year or less. They are also referred to as T-bills. Now, how did finance professionals come up with these asset classes? And how does a given security fall within one of them? For example, why do we consider Alibaba stock an equity security and not a fixed income one or a money market instrument? And we can pose a similar question not just for Spanish bonds and T-bills that are also mentioned here, but for every single security that falls into one of these three asset classes. The answer to these questions has to do, among others, with the risk and return characteristics of a given security. And for the time being, don't worry how we measure risk and return. So the risk-return profiles of certain securities exhibit certain commonalities, and these commonalities allow the investment community to group them together. And these groupings are what we refer to as asset classes. For example, equity securities have historically been the riskiest of the three asset classes, but have also offered the highest returns over the long term to their investors. And for illustrative purposes, I've prepared a graph on the next slide. So this is more or less the historical relationship between risk and return for portfolios of securities comprising of the three asset classes. Notice that we have return on the vertical or y-axis and risk on the horizontal or x-axis. Over here, you can graphically see what I previously mentioned. That is that among the three asset classes, equities have historically been associated with the highest risk, but also the highest return. Bonds fall somewhere in between equities and cash equivalents in the risk-return spectrum. And finally, cash equivalents are associated with the lowest risk and return. We'll come back to this graph in the future to make certain clarifications, but also because we can use it to make a number of important observations. To give you an idea, one such observation is that historically, higher risk is associated with higher return. In other words, there's a trade-off between risk and return. For example, if you as an investor wish to realize high returns, generally speaking, it'd be unrealistic for you to expect to do so by investing in low-risk securities such as cash equivalents. Let's now go back to the reasoning behind the classification to different asset classes. We are left over here, but risk and return characteristics is not the only factor defining an asset class. Financial characteristics or features is another one. Securities falling in the same asset class tend to share similar financial characteristics. For example, bonds tend to make periodic interest payments, what you might know as coupon payments. This is one such financial characteristic that helps distinguish bonds from securities falling in another asset class. To give you another example, we previously referred to the fact that money market instruments have original maturities of lower than or equal to 1 year. In this case, this is a characteristic that helps distinguish money market instruments. Let's now move on to our final factor, laws and regulations. Securities falling in a given asset class are generally governed by the same laws and regulations. I'll close this video by pointing out that besides these three asset classes that are commonly referred to as the basic ones, there are other asset classes as well. In fact, some investment professionals might choose to include those as part of the basic ones. As we progress in this module section, we will see those asset classes, one of them being real estate, to give you an example. And we will also see why I chose not to refer to them as basic. The reason I mention this over here is because I don't want you to get confused in case you do see somewhere some of those other asset classes included together with these three basic ones. Let's move on.